Hi, I'm Regina Hopkins, and I'm with the DC Bar Pro Bono program. And I'm here to give the first in a series of webinars on topics that are of importance to new nonprofit organizations. So I'd like to start by saying, first off, congratulations on becoming a tax exempt organization. I know it was a lot of hard work to get the approval from the IRS, and I just want to commend you on your efforts. And to say that the first session that we're going to talk about is what does it mean to be a tax exempt organization? Next slide. So what does it mean? Well, first for federal tax, let's look at what it means for federal tax purposes. The federal government does not uh, provide or charge real property taxes, so that does not apply. So the big exemption that you have by being a 501c3 tax exempt organization is that you're exempt from federal income taxes. And so that is the important part. In addition, people who make contributions to your organization can claim a tax deduction for it. However, is one important exception to this rule, and it has to do with unrelated business income tax. Basically, the IRS charges tax on any income that you derive from profit-making activities, which is unrelated to your charitable mission. We'll talk about that a little bit more later, but I just wanted to highlight it now. In addition, because you're a tax-exempt organization, you may also be eligible for exemption from certain excise taxes. It will depend on the type of organization and the activities you carry out. But basically, federal excise taxes, the two big ones are gasoline tax and the taxes that you pay on your telephone bills. So it's good to look into that to see whether you qualify from the excise tax exemptions. And then finally, you are exempt from the federal unemployment taxes. There are state unemployment taxes that you have to pay, but you don't have to pay the federal unemployment taxes or FUTA taxes as part of the wage withholding. Next slide, please. In addition, you're exempt from certain state taxes. Again, the state governments don't charge or assess property taxes, so that doesn't apply. But you are, generally speaking, exempt from income taxes. But it's not automatic. In some jurisdictions, such as DC, you actually have to apply for local tax exemption. It's a very simple form in those jurisdictions that do. They generally just piggyback on the federal exemption, but you do have to make the application, and if you don't, you haven't yet been approved for exemption from local state taxes. Other states, such as Georgia and a few others, you have to notify the taxing authority that you have received your exempt status, and at that point you will be exempt from tax. And then in a few jurisdictions, such as New Jersey and Virginia, it will be automatic. You're exempt from federal income tax, and the statute automatically makes you exempt from state income taxes. As I said, it varies from jurisdiction to jurisdiction. So you should check what the rules are in your jurisdiction to see what steps you have to do to make sure that you qualify for the state income taxes. It's also important to remember if you say you're a New York nonprofit, but you open up an office in New Jersey, when you do that, you have to again make sure that you qualify for income tax exemption in that state. It's basically something you should check out for every state where you're doing business. Are you exempt from sales tax? A lot of people wonder about this, and the answer is maybe. It depends. We have 50 states, and so there are going to be 50 rules, but in a lot of jurisdictions, it's not automatic. You may have to apply for it. In addition, in some jurisdictions, it depends on what you're using the things that you're buying for. For example, if you're a school and you're buying textbooks, in some states that would be exempt from sales tax, but if you bought office furniture, maybe not. So you have to check what the local rules are to see whether your organization qualifies and to what extent the exemption applies. And then finally, one other thing on sales tax, it's important to remember that just because you're an exempt organization and you may be exempt from local sales or state sales tax, It doesn't mean that someone who buys something from you is. For example, if you sell t-shirts on a regular basis, you will have to collect and transmit sales taxes from the purchasers because the people who buy the t-shirts aren't tax exempt. By virtue of, and this transaction is not exempt from sales tax because they bought it from you. There are exemptions for small or incidental sales, so they may apply if you do it on just a once a year basis. But anything that you sell on a regular basis, you're probably going to have to collect and transmit sales taxes from the purchaser. Now, payroll taxes, you are going to be subject to payroll taxes, including unemployment taxes at the state level. The one thing to keep in mind is usually under state law, you have an option of either paying the taxes as you paid payroll or electing what's called the reimbursement method. Under the reimbursement method, you only have to pay into the unemployment system when you have an employee who is terminated and who files and collects unemployment benefits. For many years, a lot of nonprofits elected the reimbursement method because, unlike for-profits who let people go and lay people off whenever there's a downturn, nonprofits tended to have very stable workforces, and so it made sense not to pay the taxes on an ongoing basis, but only on those rare occasions when you had to terminate someone and they collected benefits. Unfortunately, the last economic downturn pointed out that those sort of parameters don't really apply anymore. A lot of nonprofits who had elected the reimbursement method found themselves in a very difficult situation in the last few years when they had to lay people off at a time of significant economic stress. And then they were presented with a bill for many thousands of dollars from their local jurisdiction to reimburse them for the unemployment benefits the local jurisdiction paid to their laid off employees. So that's something to keep in mind when you decide how you're going to pay into the unemployment system. Next slide, please. On the local level, the big exemption is for real property taxes. Whether you're eligible to receive an exemption from real property taxes on any buildings you own will depend on the jurisdiction. In some states and localities, there'll be a broad exemption for any 501c3 on property taxes. In other jurisdictions, the exemption will only be available for those properties that are used in connection with your exempt purpose. For example, again, using our school, if you have a school, they would not charge you sales tax for the building which you owned where you held school. But if you had apartment buildings, you owned an apartment building that you regularly rented out for profit to the general public, then in that case, you may not be exempt from from property taxes, because that is considered an ordinary use and not an exempt use. Generally speaking, if there is local income and sales tax, they're going to generally follow very closely on the state rules as to whether you're exempt or not. But you want to verify that. And finally, on payroll tax and occupational taxes, in some jurisdictions, it's not uncommon for lawyers or doctors or others to have an occupational tax. And in those cases where they're working for a non-exempt, tax-exempt organization, they may be exempt from having to pay those occupational taxes. So it's good to look into that. Next slide, please. So you're tax exempt, great. So what do you do to make sure that you remain tax exempt? Because the IRS retains the right to withdraw your tax exempt status if you don't follow certain minimum rules for tax exempt organizations. So we'll go through those quickly now. Next slide, please. So how do you stay exempt? Well, you have to comply with the ongoing requirements. Next slide, please. Next slide, please. And those are, first, that you have to serve a mission, you have to serve a public purpose. Can you go back a slide? I think we went too far. You have, next slide, please. Next slide, please. Next slide. Yes, that's the slide. Back one. So how to stay exempt? You have to have a public purpose, and it must not violate the private benefit and private inurement rules. You cannot engage in excessive lobbying or any political activities. You cannot engage in an excessive amount of unrelated trade or business activity. You must meet the IRS filing requirements, and you can't do anything that would violate public policy. I'll just speak to that last one quickly. What that means is that you cannot engage in things like discrimination. The most famous case of the past few decades was Bob Jones University. Bob Jones University banned interracial dating amongst its students, and the IRS withdrew its tax exempt status because it said it was violating public policy. Bob Jones University appealed, and the case went to the Supreme Court. And the Supreme Court said, in fact, that the IRS did have the right and the obligation to withdraw tax exempt status from any organization that violated public policy. So it's not small things, but it's not something that's done lightly. But you do have to be careful. There are limits for your tax exempt status in this area. Next slide, please. So what is serving a public purpose? Well, an organization, in order to receive tax exempt status, must have a mission that is charitable, religious, educational, scientific, literary, testing for public safety, fostering national or international amateur sports competition, and preventing cruelty to children as well as animals. And all of this is described in your application for 1023, whatever mission you have that meets this test. If you make significant changes to your mission, you must disclose it to the IRS on the annual reporting form you file, either Form 990 or 990EZ. We'll talk about that a little bit later. And a significant change would include changing from one activity to another, such as moving from a mentoring program to teaching English as a second language, or adding a substantial new activity such as providing daycare services for clients attending job training. And the reason is that the IRS wants to have the right to revisit your exempt status if you make such substantial changes. Your grant of exempt status was conditioned on you promising to engage in certain activities. If you add substantial new activities, some of which, like daycare services is a good example, are engaged by for-profit entities as well, the IRS wants to make sure that you are doing it in a manner that's consistent with an exempt organization. And they want the opportunity to at least be put on notice that you're doing so. You're also supposed to report any significant activities that are discontinued. Again, if your exemption was based on a representation that you would engage in certain activities, and if you discontinue that activities, the IRS at least has the right to revisit your exempt status. Next slide, please. The other thing you have to be careful about is that you don't violate the private inurement rule. The reason why your organization is tax exempt is, in fact, that you serve this public purpose of fostering one of those charitable missions that we talked about on the previous slide. And those assets that come into that are donated to your organization must be used to foster that public purpose. If they're used to benefit a private individual and not the public via your mission, then you have violated the private inurement rule, and you may be at risk of losing your tax exempt status. The private inurement rule says that you cannot use the assets for the benefit of insiders. For example, the organization cannot pay more than fair market value for services provided by an insider. This includes paying senior staff more than reasonable compensation. A good example is you have a building that your founder owns. The founder wants to sell the building to the nonprofit. The building is worth $300,000, but the nonprofit pays $550,000. That would be a violation of the private inurement rule because you're paying more than fair market value for the property, and you're in effect taking $250,000 of the assets of the nonprofit and giving it to the benefit of the private individual. the founder in this case. So the private enrollment rule says that you cannot use these assets for the benefit of certain insiders. These include the founder, officers, directors, and senior management, such as your executive director or CEO, a chief operating officer. It also includes the insider's spouse, as well as his or her parents, siblings, children, grandchildren, grandparents, and their spouses as well. So basically, your family members and certain corporate insiders cannot use assets for the personal benefit, and if they do, that's a violation of the private enrollment rule, and the IRS can revoke your tax exempt status. Next slide, please. Similar to that is the private benefit rule, and you cannot use the assets for the private benefit of others, even though, and as I said, this is similar to the private enrollment rule, except that it's not limited to insiders. For example, let's say you own a building, but you can't use all of the space as part of your exempt operations. So you want to rent it out to somebody to get rent, the part of the building to get rent to help support your organization. And if you charge below market rent to a board member's friend, that would be using the assets to serve a private individual's interest, in this case, the board member and their friend, and not the organization's exempt purpose, because obviously it's in the organization's best interest to maximize the amount of income it could receive from the building. So that's a violation of the private benefit rule. You can always provide assistance to individuals who meet your service criteria. If you have someone who is like a friend of a board member who is eligible and meets the eligibility requirements for receiving a scholarship for your organization or housing assistance, that's acceptable because they fit the class of charitable beneficiaries, but you cannot use the assets for the benefit of people in any other context. Next slide, please. Now, a nonprofit can engage in lobbying. However, it cannot be more than an insubstantial part of its activities. Now, lobbying is defined as attempting to influence legislation. And there are two tests for determining whether an activity is substantial for purposes of whether you're using too much of your assets on lobbying. The first is what's called the facts and circumstances test. And under this test, the IRS will look at all the facts and circumstances to determine if the lobbying is an insubstantial part of your activities. And if it's not, then you could be at risk of losing your exempt status. In looking at measuring this test, the IRS will look at a lot of different factors, including the amount of volunteer time that's used for your organization, monies expended, other measurements. So it's a very broad test and looking at how much of your organization's mission is engaged in lobbying. Well, this was a very difficult and disconcerting test for a lot of organizations because the IRS never came out and said, this is how we define insubstantial. They don't, generally speaking, they haven't said, if you're below this percent, you're fine. And for a lot of organizations, especially those that engage a lot in public advocacy, you know, the dividing line between what is permissible and not can be a little dicey. So people were very nervous about how do I meet this test and ensure that I'm not going to lose my tax exempt status. So the IRS, the Internal Revenue Code now has a provision called 501H. And under this provision, you can make what's known as a 501H election. And what it does is it gives you some bright line rules that you can follow to make sure that you're not engaged in substantial lobbying activities and at risk of losing your exempt status. And how much you can spend on lobbying is a feature of your income. For example, you can spend the first 20% of your 20% of the first $500,000 of your exempt purpose expenditures, 15% of the next 500,000, 10% of the 500,000 above that, and 5% of anything remaining up to a total of $1 million. So as you can see, for smaller organizations in particular, you have a lot of more leeway in terms of expending money for lobbying activities. Now, you file a 501H election. There's a form that you file with the IRS. Um, the good news is it's based on monies expended, so volunteer time and other things are not taken into account. It's only when you get to be a very large organization that you forego the 501H election. Um, Most people feel that in order to meet the facts and circumstances test, in light of this table or this rule with these various amounts, people now kind of feel that if you're going to pass the facts and circumstances test, you should be under 5% of your activities would be considered insubstantial. Once you hit 5% or more, then you're really at risk. So very large organizations, because 5% is a much larger sum than $1 million, will not go with the election. But smaller organizations, if they're going to engage in a significant amount of public activity, may be well advised to make the 501H election. Now, there are sublimits in this. The IRS makes distinctions between grassroots lobbying and direct lobbying. Direct lobbying is when you directly contact a legislator about a bill, and grassroots lobbying is when you instead contact your members and say, call your congressman or write to your congresswoman or contact your city councilor. That's called what's known as grassroots lobbying, because you're not contacting the legislator directly, you're encouraging others to do it. And so when you make the 501H election, you should work with an attorney to go through what the other rules are, because they do differentiate between certain types of lobbying and others, and there are limits on how much you can engage in one type of lobbying versus another. But it is something to consider whether you want to make the 501H election. Next slide, please. In addition to lobbying, the Internal Revenue Code has an absolute prohibition on political activity. A nonprofit cannot engage in any political activity, and if they do, they will lose their tax exempt status. Political activity is any activity on behalf of or against an individual running for office. The IRS has very specific guidelines on what is political activity, and generally speaking, it's any activity that shows a bias in favor of one candidate or against another. In most instances, contributions of time, money, or other things, such as endorsements or lawmaking rankings, are not permitted. So you cannot bring one candidate to a forum to speak on behalf of their candidacy without inviting everybody. You can have voter education guides, and you can have candidate forums, provided everybody is included and the questions are asked or on a broad range of topics and in a neutral manner. But anything that sort of focuses on a single candidate or gives them an exclusive opportunity to speak or address your members or your donors would be inappropriate. Lawmaking ratings are not permitted, like if you give somebody an A versus a B versus a C, because obviously you're expressing opinion about that lawmaker by assigning the grade. Next slide, please. We talked about before that a nonprofit may not use its exempt status to unfairly compete with for-profit businesses. Therefore, they are subject to tax on any income they earn from a trade or business that's unrelated to its exempt purpose. And a nonprofit cannot engage more than an insubstantial amount of its activities on carrying on unrelated trade or business. You were granted exempt status because you were going to serve a charitable mission, and if you in fact engage in for-profit type of activities, the IRS will say that you're at risk of losing your exempt status. In addition, income generated from debt financed property, like a building bought with a mortgage, may also be subject to tax. There are a lot of exemptions, a lot of nuance to those rules. So if you ever buy property using a mortgage or some other loan, and you want to use it to generate income, such as subletting part of the building out to a tenant, you want to work closely with your tax advisor because you may end up inadvertently incurring taxable income if you don't do it carefully. Next slide, please. So the first question is, what is a trade or business? Trade or business is any activity that's regularly carried out for a profit. If you do any sort of event and the goal is to generate a profit, that's going to be a trade or business. So the next test is whether there's a substantial relationship between the activity and your mission. There are a lot of organizations that engage in a trade or business, but because it's part of their mission, it's not unrelated and therefore not subject to this tax or the possible loss of exempt status. For example, you're a school and you charge tuition. That's directly related to your exempt purpose, and therefore it's not unrelated trade or business income. Another example is you're an arts organization. You teach children dance, and every spring you have a big fundraiser where you have a recital where all your children perform, and you sell tickets to this performance as part of your fundraising activities. That would not be considered an unrelated trade or business because having your students perform dance is very much part of your mission. You're there to teach them how to perform dance. And so therefore, the activity is related to your exempt purpose, and any income you received, although it may be, generate a profit strictly in the sense of your income exceeds your expenses, it would not be unrelated trade or business income. So the next question is the activity regularly carried on? A good example is a car wash. A car wash is a trade or business. It's generally not related to your organization's exempt mission. But if you have a fundraiser, you're a youth group, and you have a fundraiser twice a year where you have a car wash, that's not regularly carried on. So although it's a trade or business and it doesn't relate to your youth missions, your youth group's mission, it is not regularly carried on. It's not unrelated trade or business. But if you did it every, 3 times a week, every week, 52 weeks a year, that very well could be a regularly carried on trade or business that's unrelated to your mission, and that could generate taxable income. So the test is, does it show a frequency and continuity, and is it pursued in a manner similar to comparable commercial activities of for-profit businesses? I will say this, there is a few things that you have to keep in mind. Just because you do something seasonally doesn't mean that it's not regularly carried on. For example, you sell Christmas trees. You set up shop in November. You sell them to the public 7 days a week, 10 hours a day, every day from like mid-Thanksgiving, mid-November to Christmas. Well, is that regularly carried on because it's carried on for about 6 weeks? The answer is very possibly yes, because no one sells Christmas trees other than during that period. So there's a question of whether, because you're carrying it on as frequently as a comparable for-profit business, it may be subject to tax. So that's just something to keep in mind, that just because you only do it for part of the year does not necessarily answer the question whether it's regularly carried on. Next slide, please. There are some statutory exemptions from the unrelated trade or business income that are important, and also to keep in mind when you're determining whether or not any activity you engage in would be subject to tax. The first thing is passive income, royalties, rents. You own a building, you rent it out. That rental income, because it's passive, will not be considered taxable income because it's exempt by law. Now you have to be a little bit careful here. Rent would not be subject to tax. However, if you engage in the active management of that building, if you provide janitorial services directly instead of hiring someone to do that, you do the repairs, you actively solicit tenants, there's a risk that that income will no longer be exempt because it's no longer passive income. Instead, you're actively engaged in the management, and some of that rent may be, in effect, payment for those management services and may be subject to tax. Now, a business, if substantially all of the work is carried out by volunteers, is also exempt. Let's go to our Christmas tree example. So you're selling Christmas trees 7 days a week, 10 hours a day for 6 weeks from mid-November to Christmas. If all of the people doing the sales are volunteers, or substantially all of them are volunteers, then it's not going to be taxable income, because even though it's a trade or business, even though it's not related to your mission, even though it's regularly carried out in the same way that any other Christmas tree vendor carries it out, it's carried out by volunteers, and so therefore there's an exemption for that. In addition, a business carried on for the convenience of members, clients, or employees is also exempt. The best example of that is a museum may have a coffee shop or cafeteria in the building. Is it a trade or business? Yes. Is it connected with the museum's mission? No. Is it regularly carried on? Yeah, it's carried on whenever the museum is open, the cafeteria is open. But the reason why they're carrying it on is not to make a profit, but for the convenience of their guests, the people who visit the museum. If you visited the museum and you then had to leave to go and have lunch, you may not come back. And so the museum puts the cafeteria in there so that you can have lunch and then continue to enjoy the museum. It's a way of encouraging people to stay at the museum, and so under the statute, it's not exempt. It's not subject to tax. It's exempt from tax. Another exemption are thrift shops if substantially all of the income items are donated. Basically, you'll see them, a lot of charities have thrift shops, and the rule is that if they are selling donated items, then they are the income from that thrift shop is not subject to unrelated trade or business income tax. Bingo games, if they are legal, were played and not regularly carried on by a for-profit business. That's sort of for those of us who grew up Catholic and we're used to seeing the local church have bingo games. That's the explanation for that. And then distribution of low-cost articles in exchange for a charitable donation. These are the things you'll see. Make a contribution and we'll give you a mug or an umbrella or some other low-cost items. The IRS has rules, dollar limits that they publish every year for what is considered a low-cost article. It's usually like $9–10, somewhere in that range. It's adjusted every year for inflation. So what you should do is look at what the rules are for what is considered low-cost articles, and see what the rules are for 2014 and every year thereafter, and see what you can do in exchange for a donation. We talked a couple of times if, like for example, if substantially all of the work is carried out by volunteers or substantially all of the items are donated. Generally speaking, for purposes of UBIT, if you're above 85%, you're probably okay on the substantial. So if more 85% or more of the work is carried out by volunteers, or if 85% of the more items at the thrift shop are donated, you are you're probably okay. If you get below that amount, then you might be, that's an area of concern. So again, there's no bright line. The IRS has no bright line here, but that's generally speaking where most people draw the line of feeling you're okay or not okay. Next slide, please. In addition to all these other requirements, there is another and a very important requirement, is that you meet the annual reporting requirements. Every tax-exempt organization must file an annual report with the IRS. There is a limited exemption for churches and church-related organizations, and whether or not, what type of form you have to file depends on the size of your organization's gross revenue. Generally speaking, there are 3 forms that you have to choose from: Form 990, Form 990EZ, or 990N. And as I said, it depends on your gross receipts. If you were a private foundation, you would file a 990PF, but we're going to assume that everybody on this watching this webinar is a public charity. So what are the rules? A nonprofit may file a Form 990-EZ if its gross receipts are less than 200,000 and it has total assets of less than 500,000. A nonprofit with gross receipts that are normally less than or equal to 50,000 may file a 990-N. Everybody else, so if your gross receipts are 200,000 or more, or you have total assets of 500,000 or more, you're going to have to file the full 990. But if you're smaller than that, you can file either the 990-EZ, and for very small organizations with gross receipts of 50,000 or less, you can file a 990-N. Next slide, please. The 990-N is due the 15th day of the 5th month following the tax year. So if you were a calendar year taxpayer, it would be due May 15th. The form is filed electronically through the IRS website. It's a very simple form. It just asks for your name, address, a trade name if you use a trade name that's different from your name that you were incorporated under, your employer identification number, the tax year that you report. Do you file your taxes on a December 31 basis or a June 30th basis? They want you to disclose that. The name and address of your principal officer, your web address if you have one, and you have to just affirm that your income is below the filing threshold for a 990-N. Next slide, please. And this is the important part. An organization will automatically lose its tax exempt status if it fails to form some form of the 990, either the 990, the 990-EZ, or the 990-N, at least once every 3 years. And the IRS takes this very seriously. The revocation is automatic. The IRS has no discretion about waiving the revocation. And every year they revoke the tax exempt status of tens of thousands of organizations for failure to file one of these forms at least once every 3 years. Now, generally speaking, as I said, if you're a small organization, you'll file the 990-N, you do it because it's very simple, and you don't have to need the help of an accountant or anybody who or a lawyer in filing the form. The only exception, and we talked about it earlier, is if you make a substantial change to your mission. You either discontinue an activity or you add a significant new activity. You will have to file either the 990 or probably more likely the 990-EZ because it's a simpler form, in which you disclose that change to the IRS. And that puts them on notice that you have changed it, and the burden is now on them to say that we're not comfortable with your changed mission. If they most likely never say anything, almost certainly, very likely never say anything, then you have put them on notice, and they cannot come back later and say, well, you never told us you changed your mission, so therefore we have a right. We can go back and revoke your status. So that's why you may want to file a 990 or a 990-EZ. In addition, a lot of organizations that could file either the 990-EZ or the 990-N choose to file the 990. It's a longer form. It's 12 pages with several schedules, but it gives a real opportunity for an organization to tell its story. There's a lot of places on the form where the organization can describe the great activities it carries out, how efficient they are in terms of spending their money on program as opposed to overhead. It allows them to lay out all the ways that they engage in good governance practices. And so a lot of organizations that feel that they have a great story to tell opt to file the 990 because it gives them a chance to explain to funders and the general public just what a great story what a great organization they are, and they use it as much as a marketing device as anything. So it's a lot of work for very small organizations, so it may not be something you choose to do, but as you get somewhat bigger and maybe are on the borderline between a 990-EZ and a 990, you may want to consider filing the full 990 just because it gives you that opportunity. In addition, you may have to file a copy of your 990 with the state governments. In DC, it's not required, but in New York, New Jersey, it's required. In other states, it's required unless you're filing a 990N, in which case you may not have to file anything. However, in Maryland, if you're not filing a 990, they have their own form that you have to file, which sets forth much of the same information. So what you want to do is just double check with your local authorities to see whether or not you should be filing a copy of your 990 with them so that they can, so that you satisfy the local requirements as well. Next slide, please. Or that's the last slide, excuse me. So that's the end of our presentation. I hope you found it helpful. And we will be having other presentations also available on other topics such as governance, intellectual property, employment law, risk management, and other types of record-keeping requirements, other topics of importance to